So this is the outline of the presentation today. We will take you through the sector and credit outlook, the key rating drivers, as well as the other rating considerations and unique features for this transaction. It's not often that we have a webinar on specific issue ratings, but we are working towards more investor engagements, especially if it's a unique structure or a new asset class. So if you allow me to move on to the sector and credit outlook, I think the overarching theme is the global shipping sector is inherently cyclical and volatile, but the domestic scene is seen to be more stable. So firstly, on the global front, demand is for the sector is cyclical, tied to trade activities, which correlates with economic growth. And supply, on the other hand, tends to be quite prone to boom-bust cycles. We have seen in the past the tendency of large shipping players placing large order for ships when freight rates are high. And the boom-bust cycle also happens due to the period required to build these new ships, which typically takes a few years. So this was seen happening again in the past couple of years when freight rates surged to unprecedented highs in 2021. So since fourth quarter of 2020, we have seen sizable orders placed for new ships. So according to Alpha Liner, which is a renowned provider of statistics for the shipping sector, total capacity that has been ordered as of a few months ago stood at about 7.7 million 20-foot equivalent units or TEUs, which is actually a sizable 30% of existing capacity. So these new builds are set to come on stream over the course of this year and the next couple of years, which will dampen global freight rates. The other aspect of the global shipping sector is that it's the capex intensity. High capex requirements are needed for new builds and also maintenance of older vessels. The sector is also very competitive. In the past, we have seen overcapacity, stiff competition, and sluggish trade activities have caused shipping companies to exit the segment. And on the domestic front, we have seen the same for MISC and Hubline, which have exited the container liner shipping business in 2012 and 2015. Still on the global front is the freight rates, which the falling global freight rates have been dominating shipping sector headlines. But before I talked about the substantial correction, I'll just dial back to the reasons that caused the rate surge to begin with. So in second half of 2021, the low global freight rates, which was at about $1,400 per 40-foot equivalent units, as shown here in this FreeTOS chart, actually surged to unprecedented highs due to supply chain disruptions. And this is caused by port congestion and shortages of containers and vessels. At the same time, there were also strong demand for goods, which collectively push rates up to above 10,000 US dollars. Now, global freight rates had since the second quarter of last year corrected substantially to near pre-pandemic levels. And this is as supply chain disruptions eased. Demand outlook has also grew dimmer, especially in the second half of last year, amid economic uncertainties and also inflationary pressures and recession risk. The other phenomenon that actually weighed on global freight rates is also the destocking phenomenon, where retailers who have overstocked inventories during the times of supply chain disruptions try to reduce their inventory overhang. And of course, at the back of it is also the anticipated influx of new capacity that I spoke of earlier. And these factors have collectively led to the substantial correction in the global freight rates. So going forward, we do expect global container shipping demand to remain weak for the rest of the year. And this is weighed by the softer consumer sentiments on the back of the weaker economic prospects. And along with the incoming supply of new capacity, this will dampen the global freight rates. But at the same time, we have a stable outlook on the domestic shipping sector. We see the domestic landscape as much more stable, underpinned by the base demand for goods between Peninsular Malaysia and East Malaysia. Incoming capacity for smaller feeder vessels on the global front is also more manageable, as the sizable orders that I spoke of earlier were made mostly for larger ships. And domestically, there's also been limited capacity growth by domestic players other than MTT shipping. And on the broader note, the Asia Pacific region is also expected to fare better compared to the rest of the world in terms of economic outlook. So IMF has pinned the GDP forecast for the region to be at 4.6% this year, which is a tad faster than the 3.8% recorded last year. So I'll move on to the key rating drivers for MTT Shipping's AA3 P1 ratings. So the rating consider its position, its established position within the domestic shipping sector with a sizable market share. And this is complemented by a very strong management team and shareholder alignment, as well as steady debt coverage ratios. But one of the key moderating factors will be the debt-funded fleet expansion. So if you look at the chart on the top right corner, it shows the coverage for MTT Shipping. Having been established in 2010, MTT Shipping has over 12 years of operating history and has very extensive port coverage, actively plying the routes between Peninsular Malaysia and East Malaysia, which is its bread and butter routes, and also relatively more stable compared to global routes. Increasingly, its ships also sail to regional ports like Indonesia, Thailand, Myanmar, Singapore, Brunei, and India. The management estimates that it commands about 41% of the share of domestic container throughput. And if you look at the bottom right-hand corner of the slide, you can also see that some of the selected indicators for shipping, container liner shipping business for MTT Shipping actually compares quite favorably against its peers like HarbourLink as well as Chinyang. It has a larger revenue and asset base compared to its peers. The profit, segmental profit is included here for added perspective, but do note that these are recorded at different levels because of the disclosure of the respective companies. But nonetheless, I think overall, we think that MTT Shipping has a relatively lower cost base, benefiting from economies of scale and also yield maximization efforts. If you look at the product mix, MTT Shipping carries a diverse range of products, which minimizes its exposure to any particular segment. And what we particularly like is also the fact that necessities like food accounts for about 1/3 of its revenue, and basic consumer products constitute another 10 to 16% historically. So these less volatile product segments collectively account for over 40% of its revenue. The steady debt coverage ratios is also a strong anchor for the rating. No doubt the debt coverage ratios have moderated in the past few years as it embarked on its fleet expansion program. So from the over 0.8 times that we see in 2017 to 2018, the coverage has eased to, but still stayed above 0.3 times, which is a very strong level in the past few years. And in fact, the debt coverage ratio actually strengthened to above 1 time last year on the back of a rise in freight rates, as well as a growing charter hire income. And going forward, we do expect the steady debt coverage ratios to remain even under our sensitized forecast. So in our sensitivity analysis, we have assumed some of these key assumptions that you see here on the slide. We expect the overall OPBDIT to moderate to about 450 million to 500 million from the 626 million that we saw last year. And this factors in a correction in freight and charter rates of between 20 to 40%. We have also assumed some gaps between the charters when the existing charters expire or when they take delivery of new builds. We have also assumed a total capex of 290 million to 390 million, which as guided by the management. And these are mainly the remaining progress payments for the 11 additional vessels that they are taking delivery of. So overall, under our sensitized forecast, the funds from operation debt cover is still expected to stay steady at above 0.5 times over the next couple of years. MTT Shipping benefit from a very strong management team. The promoters have very wide industry experience, which extended beyond their days in MTT Shipping. The promoters each have about 32 to 41 years of relevant industry experience, having worked in other shipping companies together, including companies like Evergreen. So this long working relationship together helps to mitigate the diverse ownership that you see on the chart here, whereby the promoters hold anywhere between 2% stake in the company to Dato Sri Ong's almost 50% stake. The management team has also implemented a very regimented approach to optimize its capacity and maximize its yields. Over the years, it has invested in IT systems and various industry-specific reporting, which enhances operational efficiency and also allows them to better meet customers' requirements, as well as make data-driven decisions. The management has also proven to be quite nimble, having demonstrated the ability to adapt to the dynamic market, such as rationalizing routes when the market changes. The management also maintains a very close watch on ship prices to ensure an economical entry point. So the fleet renewal and modernization program that they have embarked on in the past few years was one such effort to actually capitalize on the low prices of new builds, and also in anticipation of new environmental regulations which could affect older ships. On the moderating factor, we do see the debt-funded fleet expansion as a moderating factor to the rating. Debts have risen more than fivefold in the last 5 years to about 550 million by end of 2022 to expand and modernize its fleet. In fact, gearing ratio pierced 1 time in 2021 as it took delivery of 6 ships that year. That said, the gearing ratio has eased to 0.5 times last year, which is a healthy level, owing to the strong profit from loftier freight rates, stronger charter hire income, as well as a full year contribution from the new ships that were delivered in the second half of 2021. So going forward, we do expect debts to peak at over 900 million, as we assumed a drawdown of 500 million on the new ICPE or IMTN facilities. But that said, we do expect the debt level to taper off as the projected operational cash flows adequately covers the capex requirements over the next few years. So under these assumptions, the gearing will hover at 0.6 to below 0.8 times, while the debt to OPBIT ratio will be comfortable at below 2 times. Moving on to the other rating considerations and the unique features of this transaction, we like to highlight that there's no notching for subordination risk and the other transaction features. So firstly, on subordination risk, the proposed ICP IMTN will be issued at holding company level, while at the same time, there are substantial assets at the subsidiaries levels, which are collateralized for their respective borrowings. So this gives rise to subordination risk, as Sukuk holders will be ranked second after the secured lenders at the subsidiaries levels. But that said, we have not notched down the preliminary issue rating for structural subordination due to the mitigating factors that you see here on the slide. Firstly, the priority liability to total assets stood at about 35% as at end of last year, which exceeds our 30% threshold, but this ratio will decline to about 20% when the proposed ICP IMTN is issued. At the same time, there's also a negative pledge under the terms of the transaction, which prevents MTT Shipping from pledging its assets for future borrowings. So these factors adequately mitigate subordination risk in our view. Moving on to the environmental angle, we do know that the current fleet is fully compliant with the International Maritime Organization's 2020 regulations on sulfur content in bunker fuel. And on top of that, there's also a newer regulation which came into effect in the 1st January of this year. So this ruling is not applicable to three of MTT Shipping's vessels, but we like to highlight that the rest of the existing fleet and all the incoming new build at the moment are and will be fully compliant with these regulations. So aside from the environmental angle, we feel that the compliance will also give MTT Shipping a lot of advantage over older vessels that are available for charter. And on the unique features of this transaction, there will be FSRAs that will be set up for the ICP and IMTN to instill financial discipline. But the unique account will be the disposal proceeds account, which aims to provide MTT Shipping with the flexibility to dispose of its vessels without delays. So under the terms of the transaction, disposal of assets above 5% of consolidated net assets are permitted, but this is provided that the proceeds in excess of this 5% is captured in the disposal proceeds account. So I've come to the last slide, which summarizes the key factors that we have considered in arriving at the AA3 stable P1 ratings for MTT Shipping. Very quickly, it acknowledges its established market position in the domestic segment, shipping segment, with a very sizable market share, the sturdy debt coverage ratios, as well as the very strong management team. But it is moderated by the debt-funded fleet expansion, and it being operating in a cyclical and volatile sector, although the domestic landscape is a bit more stable. It is also exposed to volatile bunker costs and forex, but on the bunker fuel costs, there is a bunker adjustment factor that's typically incorporated in freight rates to enable a pass on of this cost to customers with a time lag.